Good afternoon and welcome back, everyone, to our lightning round session here, where we answer the questions that members of OptionsPlay submit to us, and we try to go through as many as possible to help you answer your questions with regards to the markets and your questions with regards to options trading. Let's see. Now, I see a bunch of you have already chimed into the chat window. Please feel free to chime in if you're joining us for the first time. Say hello, let us know who you are, where you're from. We have a very vibrant community of members and traders who support each other and help each other become better traders. And part of these lightning round sessions is to help you answer all of the questions that you have as members. And we limit this only for members so that we try to get through all the questions, as many as possible, and make sure that you have your questions answered with regards to options trading and your questions regarding the market. And many of you submitted questions prior to the session. We'll try to get through as many of those as possible, and I'll try to leave a few minutes towards the end for those of you that want to submit questions live during the session. I've tried to organize this in a way where I'm trying to answer questions that I think the vast majority of viewers can benefit from first. Kind of the more general questions, the questions that probably apply to as many of you as possible, and then kind of going down the list, getting perhaps a little bit more technical, a little bit more niche, depending on the type of questions that we are getting. Now, I do want to just start off with a little bit of housekeeping. I'm currently on the road at a conference, which is why I could not host the session this Monday morning. And my understanding is we had some technical difficulties during that session. So I did record a market outlook session on Tuesday morning after I arrived. So for those of you that are looking for that Monday morning session update from me, that has been uploaded to our YouTube channel, and you can see that session here now as of yesterday. And Philip just posted that link into the chat window here right now. Okay, so let's go ahead and get started. Let's just jump right into it. Like I said, I've organized this in a way where we are trying to focus on kind of the questions that that I believe that the majority of viewers here can potentially benefit from. So let's go ahead and get started. One of the first questions that I see here is how do you determine when to use puts or calls in a credit or debit spread? Great question. So this is for if you're relatively new to vertical spreads. We use vertical spreads a lot here at OptionsPlay. I would say probably close to 70% of our daily plays are in some form of a credit or debit vertical spread. So it's important to understand the differences between the calls and puts on debit and credit spreads. So when we think about debit spreads, they're very similar to long call and long put, meaning you use the call debit spread when you are expecting a bullish outlook on the particular stock, and use the put debit spread when you have a bearish outlook on the underlying stock. So debit, just like a long call, long put, which is a debit, uses the same strategy driver as the long call, long put. Now, when it comes to a credit spread, you basically reverse it. So think about a short put is the bullish strategy, and a short call is the bearish strategy. And when you're thinking about a credit spread, the short put and the short call are the two primary strategy drivers of the strategy. So when you are trading a put credit spread, that is a bullish strategy, and when you're selling a call credit spread, that is a put credit spread is bullish, and a call credit spread is bearish. So it's the opposite if you're buying calls and puts. When you're selling calls and puts, you basically take the opposite. You usually think of this like a T-chart, right? Calls and puts are bullish and bearish if you're buying, and then calls and puts are bearish and bullish if you're selling. Hopefully that clarifies that for anyone who's a little bit confused about calls and puts with debit or credit spreads. I had a couple of questions along similar veins. A lot of questions around, I'm a relatively new trader. I have a relatively small account or something along these lines. I have limited amounts of capital. What is the best option strategy that I should be learning to get started with options trading, especially if I have a small account? And I've been pretty vocal about this over the last 4 or 5 years with regards to, if you have a limited amounts of capital and you're starting out, there's really one strategy that I think you need to master and learn to help you grow your trading account, and those are credit spreads. The reason I say that is because even though there isn't necessarily an advantage to selling credit spreads over, let's say, trading debit spreads, the difference between the two comes from a psychological perspective, because debit spreads are low probability of profit trades that have high risk to reward ratio. What that means is that every single time you lose money on a debit spread, you tend to lose relatively smaller amounts. But when you win you tend to win a much bigger amount when you're trading a debit spread. A credit spread is the exact opposite. Every single time you win, you tend to win smaller amounts. And when you lose typically a bigger amount. Now, one is not necessarily better than the other. However, the difference between the two is that with credit spreads, because you are winning more often, psychologically, I tend to find that traders who are starting out, traders who are struggling with growing their accounts, psychologically, when you win more trades than you lose, you tend to have more mental energy and want to improve and have the desire to continue to learn and try to improve your trading. Even if your end result is the same as someone who's trading debit spreads, psychologically, it's different. And that's why I tend to say to investors that when you're starting out, between debit and credit spreads, both of those strategies have limited risk, which is a really good starting point for beginners, because you know exactly how much you can potentially make, you know exactly how much money you can potentially lose. And that also means that you have absolutely no um, um, you have no one to blame other than yourself if you ever have a trade that quote unquote loses too much money, because the only person that has control over how much you are risking is yourself, and you know exactly how much you could potentially risk before you get into the trade. So if you find yourself after a trade losing quote unquote too much money, then the only person you can blame is yourself. And that means that you have full control over how much you can potentially lose. So these limited risk strategies give you full control over that risk element. So if you have a small account, you risk small amounts every single time you trade. And then you learn to build your more of your confidence. You learn more of your ability to grow your trading account when you sell credit spreads that naturally have just even if you just randomly pick credit spreads, you're going to win 60% of your trades. That's just the nature of credit spreads. So when you already are winning 60% of trades, even though the 40% of the time that you are losing money, you might be losing more money than what you're making on the 60%. But when you win more often, you tend to just have a little bit more mental clarity and energy to want to improve and get better at your trading than if, let's say, right off the bat, you're only winning 35% of your trades, which is what tends to happen when you're trading a debit spread. So that's kind of my advice for anyone who's asked questions along the vein of, I have a small account, I'm starting out with this limited amounts of capital, what's the best strategy for me to get started? The next set of questions that I got, similar type questions, were around the wheel strategy or generating monthly income through a investment portfolio. So I'll just kind of word a couple of the questions that I saw. Is how do I do cover calls on monthly dividend stocks without the risk of losing the dividend because of the short call? And what this person is essentially asking is, how can I sell cover calls and not have the risk of the stock being called away? And really the only way to go about doing that, to ensure that you basically can keep your stock and keep earning the dividend on your stock, is to have a methodical approach to when you enter and when you roll that cover call. And the rules are pretty straightforward. They're pretty black and white, and they're easy to follow. And for anyone who's managing a cover call portfolio, this rule should be relatively easy to follow, which is that you want to sell a cover call that's roughly 45 days from expiration as a starting point, and you hold that cover call until about 2 to 3 weeks from expiration. It doesn't really matter whether you pick 2 to 3 weeks. It's just a matter of being consistent and whatever the process works best for you. So for example, let's say you choose 2 weeks out. So you sell a 45-day option on the stock that you own. And when that call option is 2 weeks from expiration, what you do is you roll out that cover call. You basically sell a new 45-day cover call and buy back the call option that you've sold a few weeks ago that's now only 2 weeks from expiration. And you continuously do that roll, but you have to do it consistently, roughly 2 weeks from expiration. And that's going to avoid an early assignment on the stock, and that's going to avoid you losing the stock and losing the dividend of that stock position that you own. So that's generally speaking the rule of thumb. If you're selling cover calls, how can you avoid the early assignment, or rather, just how can you avoid losing the stock so that, number one, you don't have a taxable event, and that you don't lose the dividends from owning that particular stock. There was another question here saying, my biggest challenge right now is picking the right stocks for the wheel strategy. Can you provide some guidance? Just for those of you that are brand new, if you don't know what the wheel strategy is, this is basically when you're selling cash secured puts on stocks that you want to purchase, because the cash secured put gives you the ability to purchase that stock at a discount. And then once you own that stock, what you're doing is you're selling cover calls, continuously selling cover calls until the stock gets called away. So, as you are looking to acquire the stock, the short puts generate income, and as you hold the stock, the cover calls generate income. So you basically are holding onto the stock, you get the capital appreciation potentially of the stock, but while you do all of that, you're earning income every single month on that particular stock that you wouldn't have if you just simply bought the stock and sold the stock. So the question here is, how can you pick the right stocks for the wheel strategy? And that's a really great question. However, it's a question that, differs for everyone, because it depends on your risk tolerance, right? Someone who is more risk adverse is likely going to, someone who's more risk adverse, who's approaching retirement, is likely going to pick a blue chip dividend type stocks predominantly, lower risk, lower beta type stocks, and focusing more on income, less on capital appreciation. For someone who's much earlier in their investment career, or could not, in their overall life, and they are willing and capable of taking on more risk, that's really where you'd focus on more growth type stocks. So it depends a little bit, depending on each person. However, I will say, when I look at stocks to purchase, there's a couple of things that you really want to pay attention to. And if we really have to nail it down to a couple of things that are really most important to me, number one is valuation, and number two is profitability. And those two things are linked. The more profitable a company is, generally the higher the valuation it trades at. The lower the profitability, the lower the valuation that it generally trades at. And what I typically look for are stocks where there's a little bit of a disconnect, meaning perhaps they're trading at a lower than average valuation, but they actually are more profitable than their peers. And for anyone who's followed any of the research that we've put out for the last 8 or 9 months on a weekly basis, these are the types of stocks that we try to identify. And we actually have a list of undervalued stocks on our global watch list in the OptionsPlay platform. And it basically gives you a list of stocks that meet this particular criteria, where they're relatively undervalued relative to the profitability of that stock. Now, the other thing that I do recommend for investors to do if you're buying any particular stocks, and this is regardless of whether it's for the wheel strategy or just the stock that you're buying in general, is to have a general understanding of what that company does. The worst thing you can do is buy a stock just off of fundamentals or just off of the chart and not know what the company does. Because there are a lot of things that simply just common sense would help you better understand whether that investment is suitable for you or not, and whether it's just a good idea or not. You can potentially have stocks that are undervalued, that are potentially very profitable, but once you realize what the company does, maybe you have a view that this is not the right environment for this type of company. Maybe for example, oil stocks are a good example of that, right? With oil kind of reaching 52-week lows, maybe now is not the right time to be investing in oil stocks. But if you just looked at the chart and saw a symbol and you didn't know what the symbol did, you might not have realized that it was an oil stock, and you would have purchased it not knowing that. So it's just basic understanding of what a company does, how it generates revenue, how much revenue does it generate, and how much profit does it generate, in my opinion, goes a long way, especially if you can kind of peg it to a general valuation. So that is my view from a very high level, and you can actually see our overvalued and undervalued list on OptionsPlay. There was another question saying, I like to sell out of the money puts on quality companies to generate monthly income. Does your system help screen for good opportunities? So again, what I'll do is I'll kind of show you, let me share my screen real quick. So on the OptionsPlay platform, you can screen for just short puts that have the highest amount of yield. And when you go to your ideas section within OptionsPlay, so within the ideas section, there's a drop-down menu where you can select the different types of ideas you can generate that you can view. One of those ideas are short puts. You can also look at technical ideas, cover call ideas, credit spread ideas. So when you're trading the wheel strategy, you obviously need to first identify stocks that you want to purchase, and you do that through the short put list. And the short put list basically gives you that understanding, gives you a list of stocks that are generating the most amount of yield if you were to sell a put on those particular stocks. That's a good place to start. But the question is really, how do you identify the best stocks for that? And that's really where the watch list feature comes into play. And we are actually in the process of building out a feature where you can merge any watch list with a specific set of ideas so that you can kind of see, stocks that meet a particular criteria within a watch list. So that's something that we are currently working on. And as you can see, we have a list of undervalued stocks, and this is something we update once a week. So these are stocks that are potentially good candidates for selling cash secured puts, from a valuation perspective. But like I said, if you're looking at this particular list, I'm trying to look for a name that perhaps, is not a household name. Let's see. Let's look at this. NDSN, Nordson Corp, right? I have no idea what that particular company does, but maybe you looking at this particular stock, maybe you look at the chart and you like the chart, maybe it generates a nice amount of yield for a short put. But if you have no idea what Nordson Corp does, not a good candidate. Do a little bit of research, understand what they do, how do they make their money, and a lot of times common sense can give you a good sense for whether or not this is the right environment to be investing in that particular type of company at the moment. Okay, so that's generally how I think you should try to screen for good stock, quality stocks for the wheel strategy and selling short puts. How can I filter for opportunities in such a volatile market? And if I find opportunity, what's the driver to select which option strategy to follow? Great question. In volatile periods, there's really two things that you should think about, right? Do you expect volatility to continue and get worse, or do you feel that the volatility is retreating? That is a big component of how do you trade in volatile markets. If you think that the volatility is going to get worse, and I would look at kind of the current market conditions as a environment where volatility could get a little worse, right? We've seen a bit of a suppression in volatility over the last, call it 3 weeks or so, right? After the pause in the tariffs and the market had rallied substantially here over the last 3 weeks. We have the VIX back at around 22, 23. Is this a bit of a complacency that the market is sort of maybe pricing in that, we're everything with the trade wars are just all and done, and then everything's gonna be smooth sailing going forward? as we approach trade talks with China, is that going to go all smoothly? I think that there are some downside risks that the market is not particularly pricing in right now. So I'm in the camp where I feel that volatility perhaps has retreated a little bit too much, and investors are potentially getting a little bit too complacent and too optimistic about the markets. So I'm in the camp that I think that there's a possibility we could see another bit of a spike in volatility. Let's say U.S. and China go to negotiate the trade war, and they play a little hard to get with each other for the next few weeks, and and maybe some tensions get ratcheted in that process. And if that were to happen, we could see vol spike, right? So if you're in that particular camp, and you're trying to navigate that, then generally speaking, what you're going to look for are more bearish ideas in the broader markets. Whether you look for credit spreads, and I think that might be a good example of an environment that might be good for selling credit spreads. You would basically look for bearish credit spreads is one example that what you can do, right? So you can go to the credit spread section, you go to filter and filter for bear call spreads, and now you have a list of bearish credit spreads that generate a fair amount of yield. And what's really interesting right now is that we're seeing something that we haven't seen since we saw it briefly during the the volatility in the beginning of April, but we're seeing it again, which is skew. Skew is working in our favor specifically for selling call spreads right now. So as you can see, I can sell a 560, 585 call spread in June for SPY, where the risk to reward ratio is nearly 1-to-1. That doesn't ever happen. I haven't seen 1-to-1 risk to reward ratio on call credit spreads on something like SPY in a very long time, outside of the beginning of April, because credit spreads on SPY typically have about a 3-to-1 risk to reward ratio. So for every $1 you can potentially make, you're typically risking $2 to $3. Here, for every $1 you can potentially make, you're only risking $1. So this is the type of market environment where my preference is to take a look at potentially selling some credit spreads on SPY. Another thing that you can do is look at just simply bearish trade ideas. So if you go to the technical ideas, you can screen for bearish trade ideas, and this is really where you can look for opportunities, that are bearish. The other thing you can do is you can go to our watch list and look for overvalued stocks. So there's quite a few different ways on our platform that you can find, bearish opportunities. And I recently just did a webinar on this one particular topic of how do you trade volatile markets, right? And we went through kind of the different use cases and the different ways that you can use our platform for that. So, screening for bearish credit spreads, looking at bearish technical trades, and just looking at overvalued stocks. Those are some ways that you can screen for opportunities if you expect volatility to potentially pick up. Now, if let's say you feel that the worst of the trade wars are behind us, you think that we've got smooth sailing ahead, volatility is going to continue to retreat lower here, then you obviously go on the more offensive from a bullish perspective, and you basically do the exact opposite here, right? So you go to ideas. When you go to credit spreads, instead of looking at bearish credit spreads, you look at bullish credit spreads. Or if you're looking at technical ideas, you might look for bullish technical ideas, or if you're looking at your watch list, you might look for undervalued stocks, right? So it's not a one size fits all in terms of volatility or volatile markets. It really depends a little bit on your view on volatility and just your overall view on the markets. And I happen to be in the camp that we've had this really nice rally that's bounced back and erased kind of the August volatility. But my belief is that going forward, there's perhaps a little bit more pain ahead. It's not just smooth sailing going forward. Hopefully that answered your questions there. Let me stop sharing the screen here and let's go back to the questions. We got a lot of questions here over the last week or so about the 0 days to expiration trades that we were putting out. The short answer to the question of are we going to resume that is yes. We pushed that out in the beginning of April when things got really volatile and there were a lot of trading opportunities on 0 days to expiration. Right now, there just aren't many opportunities for trading those particular strategies. So we are still putting those out, but we're only putting them out when there's an actual trade to make. The volatility has just been not there. We haven't seen any movement. It hasn't been the right environment, particularly for that trade. So when volatility picks up, we certainly will continue to put that out. And it's something that we're also soliciting a little bit of feedback on in terms of what you like, what you didn't like about those specific trades, that we'll try to incorporate as much as possible into that particular newsletter. But yes, that is going to be that is something that we're still doing. A really good question came in saying, I use cash secured puts quite a bit in the past, but I've had some disaster with it. What would be the best approach to transform the OptionsPlay short put suggestions into credit spreads? And what criteria should I consider to choose from either a short put or a credit spread? Great question. The short answer to your question is that it's not particularly easy thing to do. What I mean by that is, in what this person is suggesting is, what can I do to determine whether I should sell a short put or I should sell a put credit spread? And the short answer to your question is, it depends on whether you believe volatility is going to expand in the future or not. So, for example, I'm in the camp that I think volatility could expand in the next 2 to 3 weeks as we kind of go to negotiate what is arguably the most important trade deal in the whole world between the two largest economies in the world. And what could go wrong there, right? So that's my view, is that things could go a little bit sideways, and that there's the propensity for volatility to pick up. So in that particular example, I think that credit spreads make more sense because you get the downside protection of a credit spread that you don't get with a short put. Now, here's the thing, is that volatility spikes tend to happen out of nowhere, right? Or sorry, it's not that it happens out of nowhere. It tends to happen because everyone in the market is underpriced or underestimated the potential for volatility to pick up in the future. So it's not fair to say that we always have a crystal ball of where volatility is going to be. I'm just telling you what my view is, and I could end up being wrong. So I don't necessarily know that that's the best answer, because you're not always going to have a view on volatility, and even when you do, you could very much be wrong on it, right? So my take on this is that you should just pick one strategy over the other and stick with it, but know when to get out of that trade when it's not going in the direction that you expect it to, or know when it's going south. So, for example, I got a lot of questions from clients saying that, I sold a bunch of puts prior to April 2nd. Things really screwed things up when the tariffs came in, and my portfolio is down a pretty substantial amount as a result of the tariffs, right? And, my view is that, when you're selling puts, it's a strategy that you're trading because you are willing to be put the stock unless some new information comes out and you decide that you no longer want to own that stock, right? So you're never going to be able to tell the future. So what you have to do is you have to stick to your strategy. And I would argue that for those of you that did stick to selling short puts, you probably would have done just fine if you had stuck to your strategy and didn't panic through the sheer volatility. And I know that that's hard to do, in real time when you're seeing that the markets are melting down 5-7% in a single day, but back to back. It's hard to quote unquote stick to your strategy. But the question really comes to the real question is, with the news that came out, did it change your views on the investment? And you very well could have changed your views on the investment. And if your views have changed, then that's a reason to get out of the trade, right? Meaning buy the short put back and get out and no longer have exposure in that. Otherwise, what you want to do is you want to stick with your strategy. You don't want to try to switch strategies all the time, because unless you feel that you've got a good grasp on where you think volatility is going to be, I wouldn't try to switch between short puts and credit spreads and stick to one strategy or the other. Hopefully that answered your question. Can you demonstrate how I would use my personal watch list to generate short put ideas on your platform? Great question. So when you go to short puts on our platform, there is a section here that says, there is a button here that says available on watch list. And what this does is it basically only takes the stocks that are in your watch list and filters the short put candidates based on only the stocks that are in your watch list. And it sorts it based on where you get the most yield. yield. So Microchip is number 1 out of my watch list, PDD is number 2, Nvidia is 3, XYZ Block is number 4, and you keep going down the list. So if you are maintaining your watch list in OptionsPlay, you know, a list of stocks that you like, or a list of stocks that you'd be willing. Oh, sorry. Apologies, I didn't share my screen. So if you are using the OptionsPlay platform under the ideas section, if you select short puts, there is a button here. There is a button here that allows you to only basically filter out the short put list based on the stocks that are in your watch list, right? So in this particular case, I happen to manage a pretty sizable watch list here in OptionsPlay. So I have 45 names in the short put list that are in my watch list. And so, you know, and it's sorted based on yield. So Microchip is number 1, PDD is 2, Nvidia is 3rd, and XYZ is next. And I basically go down the list and I find stocks that I really like. For example, right now, Nvidia is a good stock that I quite like here at the moment. You know, it gives me a yield of roughly 55% yield on my cash. The stock's trading at 113. This is telling me if I sold the June 6th 110 put for $523 or $5.23 per share, that's a net yield of 5% yield that I'm earning in just 30 days. That's not 5% per year. That's 5% in just 30 days selling Nvidia puts with the expectation or with the obligation to buy the stock at 110. But you know, once you include the premium that I'm collecting, my net purchase price, if it does end up being put to me, is only 104, right? Which is the level that I feel pretty comfortable buying Nvidia at, you know, because that's basically buying at around 24 times forward earnings, which on a stock that's generating, you know, 50-60% EPS and revenue growth and have net margins of 55%, I think that is one of the biggest bargains in the market right now. Block, also a relatively high performing stock from profitability perspective, has taken a huge hit in the last few months. You know, this was basically a $100 stock just in December, is now a $47 stock. It's taken a 50% haircut. You know, I also think the fundamentals on Block look incredibly strong. If I sold the $47 put, I collect $2.10, which is 4.6% of the stock's value in 30 days. And if I end up owning the stock, I ended up owning it around $45. So this is a great way to help you sort through short put opportunities on the stocks that you own. Okay. Let's see. Could you walk me through, this was a long question, but I actually think it's a question that probably many of you in some way, shape, or form are interested in, right? So can you walk me through your typical process of determining when to implement a market hedge, including key market indicators you monitor? How do you quantify and manage the potential risks associated with your hedge strategies? And what are your stop loss and taking profit criterias? What deltas do you use? How do you close your hedges when VIX is low? What do you think about a no-cost collar? So this is really like a lot of questions embedded into one, but it's all obviously related to, if you believe that the markets are potentially heading lower from where you are now, how can you implement a hedge? And this is a really good question. So, and I think pretty relevant to where we are right now, okay? Because like I said, I'm in the camp that you know, we're approaching a trade war, rather a trade deal negotiation with China. We've had a nice rally here in the overall markets. That rally has seemingly petered out a little bit here in the last few weeks, in the last couple of trading sessions. And I do think that there's potentially the risk of a bit of a short-term pullback here in the broader markets. So, you know, my views on you know, when it's time to put on the hedge is usually a combination of both macroeconomic and general technical levels, right? You know, the fact that we've had this, like I said, a very substantial rally here in the equity markets over a very short period of time, combined with the macroeconomic picture that I currently see, I see some downside risks with the overall market. So it's hard to pin down exactly, when to put on a hedge, because there are things that are just not necessarily quantifiable from a metrics perspective. It's a combination of multiple things in one that generally inform that trading decision. But with regards to what type of hedge do you put on, that's really where you can be somewhat methodical as a starting point, right? Generally speaking, I tell users to start somewhere between 30 to 60 days out in terms of expiration dates. And you generally want to look at a variety of strike prices. You want to look at in the money, at the money, and out of the money strike prices to see for yourself, what type of protection are you looking for? And more importantly, how much are you willing to pay for that protection? So in my opinion, I believe that, I do have a webinar specifically on this one topic. So I don't want to cover it too in depth here, because I can point you to that webinar where I do cover this particular topic in depth. Where I look at where I show you how you can look at options play to help you determine, an in the money, at the money, and out of the money put option, and compare the three side by side and use the P&L simulator to actually see how each of these strategies perform if SPY were to decline, let's say to $500 between now and the expiration date in June here, how these three strategies will perform, what type of returns or what type of hedges would you be able to receive from each of these trading strategies. I don't want to spend too much time in that because of the fact that I have spent quite a bit of time on that one session, and it's probably better to watch that session specifically. But what I will talk a little bit about are risk management of these particular hedges, when to take off these hedges. I'll talk about that a little bit. So just like any other directional trade that you're making, right? Because ultimately a hedge is just a directional bet on the market. The general rule of thumb still stays the same for regardless of which strategy you use. So you can hedge the portfolio by buying a put or a put spread. You can also hedge the portfolio a little bit by selling a call spread as well, like as we talked to here before, right? If you sold the June 560, 585 call spread, you can collect $12.54. That is a strategy that, especially in this market environment where, my expectation is not that even if things go a little bit sideways with the trade deal with China, it's not like I think things are going to fall apart, right? So my views on this is not that I think it's going to be moving substantially lower. I just think that, markets don't have a lot more upside from where we are right now, right? So I think selling a call spread right now makes a lot of sense. So what I would do is I would follow the same rules that I would do if I were selling a credit spread on any other stock, right? Which is, you take profits at about 50% of your max gain. You cut your losses once you lose 100% of your max gain, and then you close it out at roughly 21 days to expiration, or you roll it at 21 days to expiration as you approach it. You never hold the credit spread into expiration. So the rules for managing these trades don't change just because it's a hedge for a market for SPY, because you treat it like any other credit spread or debit spread or put option that you're purchasing. And the last question, which is, when do you potentially close out a hedge? There's quite a bit of research with regards to looking at exhaustion here on sell-offs here, right? So for example, in the last couple of trading days, when things really kind of hit the fan here back, in the beginning of April, what we saw is a phenomenon that we generally see here near market bottoms, which is the fact that the markets continue to move lower when VIX no longer continues to move higher, right? Because the VIX and the markets are inversely correlated. When the markets go down, VIX goes up, right? And vice versa. But we tend to find that as things get towards the very bottom, when the market sort of capitulates, the equity markets continue to move lower, but VIX no longer continues to move lower. We actually tend to see in the last couple of days, the two actually move in conjunction with each other. So they basically go from inversely correlated to positively correlated near those market bottoms. Otherwise, you can use sometimes technical indicators to also get a sense for, exhaustion. They're not as reliable as volatility indicators. And what I'm looking for is basically lower lows in price that are no longer providing lower lows in momentum. Very similar to the concept with the VIX, is just that momentum indicators tend to be positively correlated with the underlying. And when they no longer become positively correlated and they become negatively correlated, that's also another sign of market bottoms. But that's not as a reliable indicator. But if you do get both, if you get momentum, divergence, and you get VIX divergence, that is usually a very good sign of a market bottom. So as you think about it, and this only generally works when things kind of move into a bit of that panic sell-off kind of mode, right? If things are kind of smooth sailing, like, kind of an orderly sell-off, you don't get any of these indicators that I'm talking about, right? Because those are just kind of more of like a natural, what's the right word, rhythm of the market, right? It's not a particularly like panic sell-off like we saw here towards the beginning of April. It's really those kind of panic phases that the divergence indicator that I'm talking about will typically be a good indicator of near a market bottom and when it might be time to remove a hedge on the broader markets. Okay. Let's see. Next question. So the next question that I got is more specific to this person, but I do think that there are probably some elements of this that we can help everyone with, right? The particular question here is, can you give some guidance about structuring or allocating our accounts within a Roth IRA account? From my perspective, it doesn't matter that it's a Roth IRA. It's just, this person says they have about, let's just use nice round numbers. Let's not use the number this person used. Let's just say they have $100,000 that they have in their total retirement portfolio. And they have about, let's say, 10,000, or a tenth of that in a cash account. How much of that should they allocate to strategies like the wheel strategy for long-term holding versus trading? So generally, the rule of thumb that we use as a starting point is about, close to within the equity portion of your portfolio, right? Because, perhaps you have some portion of that allocated to bonds, but within the equity portfolio, about 80% of it is longer term investments, and about 20% of your portfolio is towards active trading strategies. And this person specifically is asking around the 2% rule that we have for active trading strategies, meaning our rule of thumb is that you should never risk more than 2% of your total account value on any single options trade. And what that means is that in any single options trade that you make, the maximum loss you should have on that trade should never exceed 2% of your total portfolio value. And that 2% is the 2% of the active trading component of your portfolio, not 2% of the entire portfolio. So you remove the 80% that you're putting into long-term investments, you take the 20% that's left, and what you want to do is every single time you make an options trade, you want to risk no more than 2% of that total account value. Hopefully that answers your question. Can I enter into a commodity options contract? Is it more safe to enter options for ETFs of those commodities? I would generally say no. From the perspective of, I'm presuming when you say a commodity options contract, you're referring to a commodity, or it's effectively options on futures. And while the risk of taking physical delivery when you're trading options on futures is relatively low, you do run the risk when you're trading options on futures that you end up physical delivery of the futures contract, and the futures contract technically has obligations from a physical delivery perspective. It adds an additional level of complexity that I think most traders just don't need if you have a direct ETF equivalent that you can trade. So I'm thinking about gold, I'm thinking about, oil a little bit less so, but like gold, silver, it depends on the commodity also, right? So for example, if you're trading lean hogs, there's just no equivalent ETF that you can probably trade options on, that track the price of lean hogs, right? Or corn or sugar, or those types of things. So it depends a little bit on the commodity itself. But if you're talking about gold and oil, right, then I think the ETF is a better way to go, in my opinion, because the ETF is cleaner. It's just you don't have to worry about physical delivery or anything like that. You don't have to worry about rolling futures contracts. There's fewer complexities with options on ETFs than there are on options on futures. I'll answer one more question, then what we'll do is we'll open this up for questions, live questions. And even right now, if you have any questions that you want to ask me live, please type your questions into the Q&A window at the bottom of your screen, and I'll try to answer your questions in the next few minutes. There was a couple of questions actually from customers asking about accessing Canadian data. So we've actually recently launched, the ability to actually subscribe to Canadian data directly on your OptionsPlay platform. So when you go to your profile and you go to subscriptions, you will now see a Canada and a US bundle. So you can choose between having access to Canada or US or both in your subscription. So for those of you that trade Canadian markets, you can choose the Canadian bundle, and what that gives you access to is basically you'll be able to pull up Canadian symbols. So for example, you put in Bank of Montreal and you're subscribed to Canada, you'll see both the US ticker for BMO, and you'll also see the Canadian ticker denoted by the flag under the symbol lookup. So you can subscribe to the Canadian data or US data directly from OptionsPlay when you go to your subscription. Okay, with that, let's go to Q&A. Let's take a look at some of the live questions. I don't have too much time here, but I'll try to go through as a few questions before I have to sign off. Going through the platform, if I look for an options trade for a ticker, I see bullish and bearish trades. Are these trades suggested by OptionsPlay? How should we read these trades? I think the question here is, and let me just pull up the OptionsPlay platform here again. I believe the question here that this person's asking is, for any symbol that you type in, let's just pull up Tesla, for example. For any symbol that you type in, he's saying that I see bullish and bearish trades. And I think he's referring to this particular section here on the right. And his question is, are these trades suggested by OptionsPlay? So it's not these trades are suggested by OptionsPlay, is that these are good starting points for bearish and bullish strategies. So for example, I happen to be in the camp where I think that there's some downside risks here for Tesla. So let's look at some bearish trades. What we're saying is that these are the three most popular strategies to take a bearish exposure on Tesla. And what we've done is we've applied the best practices for these types of strategies as a starting point. Meaning, if you're going to buy put options, we generally recommend that you start out roughly 60 days out in terms of your research, in terms of your time frame, and you want to start with a strike price that's slightly in the money as a starting point, right? That just means that if you know nothing about options and you're starting out and you're just trying to learn and you're trying to make sure that you're applying kind of general best practices, we're doing that for you. Each person obviously has, every single one of you has personal preferences or modifications that you might want to make. So someone might want to say, you know what, I have a much shorter view on Tesla. I think it's going to drop in the next 5 days. So I don't need to buy a 60-day option. I'm going to buy a 1-week option, and you can adjust your option strategy to match your specific outlook. And you might say, you know what, I'm pretty aggressive. I like to buy an out of the money put option. You can make those changes using our platform. But our point is to help make sure that you start off on a reasonable starting point, no matter whether you have a bullish, bearish, or any other outlook you have on this particular stock. When you take an options position, i.e. a long call, and the market goes the opposite way, how do you think about whether to get out? So the rule of thumb here is very straightforward. And actually, I just realized that I think I might have skipped one of the questions, because there was one question that I specifically wanted to get to, and I'll actually answer it kind of both at the same time. This person's saying, actually there's slightly different. So let me answer this first. So the question is, if you buy a long call and the stock goes in the opposite direction, how do you think about getting out? And the rule of thumb here for all strategies that we teach is that the exit strategy, especially when the trade is not going in the direction you expect it to, or specifically when the trade is not going in the direction you expect it to, is incredibly black and white. There's no ifs, buts. There's no depends on this, depends on that. It's all very clear and black and white. If you buy a long call and the market goes against you and you've lost 50% of the premium that you paid on that long call, it's time to get out. And the reason that we make it so black and white is so that you should be spending virtually zero mental energy and time and focus on losing trades. Losing trades are the market telling you that you're wrong. I don't care how much that might hurt your ego or it might insult your intelligence or whatever it is. But that is something that most traders struggle with. They struggle with the concept of being wrong, and they struggle with managing that emotion, which is why we try to make it as black and white as possible, so you spend no mental energy, no time thinking about it. You just have a clear black and white picture of saying, this is the market telling me that I'm wrong, and it's time for me to get out, make sure I contain my losses so I never blow up my account, so I can focus my energy, focus my attention on my winning trades. Because the winning trades are where the market's telling you, hey, you're right. Here's an opportunity where you can turn a small investment so far, or a small winner, potentially into a much bigger winner by figuring out, okay, I bought a long call, the market's gone in my favor. What can I do to adjust this trade to turn the small win into potentially a much larger win if the stock continues to move in the direction that I think it's going to move in? That's where you want to spend 90% of your energy and your thought, your thought cycle on winning trades. But in reality, what I tend to find is that most traders spend 90% of their trades on their losing trades. That's not where you should be spending your time. And this is connected to the next question that I wanted to answer, which is, I got a bunch of questions regarding, when are you going to teach a class on repair strategies? And the implication there was, when are you going to teach a class that's going to show me when I have a losing trade, how can I fix that losing trade? And I cannot tell you enough how that's the wrong mindset and mentality to be in if you want to be a successful trader. Successful traders spend zero time on their losing trades. They never try to repair their losing trades, because repair trades are effectively, at best, going to get yourself back to break even. And at worst, you're likely going to lose more money than you already lost on that particular trade, right? And you're just throwing good money after bad money. So and this is something that I think is incredibly hard to implement, because psychologically, everything in our human body is wired to do the exact opposite of what I'm teaching you. We sweat over the losses. We don't know. We freeze up when we have those losses, and sometimes we know what we should do, but we're just physically can't bring ourselves to click that button to get ourselves of a losing trade. Because when you close out a losing trade, you're basically solidifying a loss, and it's very difficult to do that. And when you have a winning trade, what do? We take profits early, right? Because we're so scared of, what happens if we don't take profits now, and the stock goes against us and we end up losing money again, right? That is the thing that probably hurts us as traders the most. It hurts our ego the most. And it's really, once you realize that it's your ego that's preventing you from actually realizing the what's the right word, the method or the process that's going to help you improve and grow your trading account, the better you will be as a trader. Because the market doesn't care whether you're right or wrong. Ultimately it's your bank account that does. So focus on your winning trades, not your losing trades. Your losing trades should be incredibly black and white, which is why the rules that we write for you as far as when you cut losses are incredibly black and white. It's a part of the day and in your trading process that you should be spending the least amount of your mental energy and mindset on, and focus all your energy on where the market has proven you to be right. And that is where you have the opportunity to turn a small win into a big win. And that is how you start growing your account in the long run, is you keep your losers small. Every single time you have a loser, you keep it small. And when you do have a winner, you keep trying to hit home runs. Eventually you will hit some home runs, and those home runs will offset those small losses that you make. And I would say that, out of everything that we've gone over here today, that last concept that I just talked about is arguably the most important one. If you're struggling to grow your trading account, you're trying to figure out how to be more profitable in your trading. And how many of you are struggling right now to be profitable in your trading account? Just type yes into the chat window if you are in that camp of saying, I'm struggling to grow my trading account. I have more losers than I have winners. I'm not profitable in my trading. And ask yourself, do you spend more time on your losing trades, or do you spend more time on focusing on how to adjust your winning trades? And ask yourself that question, and be really reflective, and try to be as introspective as possible, and say, where do I spend more of my time on? Do I focus on, hey, I have this losing trade, let me keep my eye on it, let me see what I do with it? Or do you actually spend more of your time on your winning trades? And I would say probably the majority of you right now that raised your hand that said that you're struggling with trading probably don't spend enough time on your winning trades and sweat your losing trades a little bit too much. With that, that is all that I have time here for today. I have really enjoyed doing these lightning round sessions. We've been doing these. This is our second one, but we are looking to do this basically every few weeks for those of you that are members here at OptionsPlay, because it's a smaller, intimate group, and it allows me to get to all of your questions. So please, we'll do the next one in about 3 weeks' time. Make sure you submit your questions. If you didn't get a chance to do it today, yes, these sessions are recorded. You're going to be able to watch the recording afterwards. So if you want to take some time and review the things that I said here, or go back and look at kind of the screen sharing sessions, these will be recorded and available to you on YouTube. But I hope that, and I just want to say thank you for all of you that are members and supporting us and allowing us to continue to do this. Thank you so much for your support, and hopefully this is a small part of us giving back to you, to showing our gratitude for your support by taking these sessions that are only available to members and answering your questions and trying to get through all of them as possible, as opposed to kind of some of the bigger groups where I can't get to all the questions. I can't even come close to getting all the questions. Here I can try to get through almost all of them in the session. So please continue to come back if you find value in this. Yes, and the replay will be available. Thank you so much, and I hope you guys have a great trading day.